Hey, welcome back to the channel. Today we're going to be checking out AutoZone, ticker symbol AZO. All right, getting into the 5-year chart here, we can see it's been on a tear over the last 5 years. Started about 674. We're sitting at 2381 right now. COVID lows was about 728. So this thing has been roaring for a while now. Let's get into the latest earnings release. I looked for like a presentation or something, and I found a 2022 general meeting, and that was just like way too long to go over. So yeah, the last earnings, it looks like they opened about 22 new stores in the US, 6 in Mexico, 2 in Brazil. Currently, they've got 6,248 stores in the US, 713 in Mexico, 83 in Brazil for total store count of 7,044. So I am going to be looking at O'Reilly's over the next week or two, and then also Genuine Parts Co., I believe, and that is the Napa equivalent, or that is Napa essentially. So we're going to go over those two in the next 2 weeks as well. So yeah, let's go over the financials now. So something that most people will know about AutoZone is that it's pretty much known for being a share buyback machine. So about 10 years ago in 2013, they had 36 million shares, and they're sitting on about 20 million shares currently. So they have been buying back a massive amount of shares on a year-by-year basis. If we look at the year-by-year, let's see, share repurchases, it usually tends between 4% to 7%, and we have some outliers, one being 9% in 2020 or 2021, no, 2022, sorry. So we can see, 7% buyback, 7, 5, 4.6, 5.6, 7, 5.5, 5.3, 9, 1.54. So they are known for buying back shares like crazy. Over the last 10 years, we can see that they've had pretty decent growth. I think their last 5-year average growth over the bottom line is about 12.14%. So pretty decent growth for them over the last 10 years, but that doesn't necessarily mean that they're going to grow at the same clip over the coming 10 years. Bottom line yields for this one typically range between about 5 to 10%. We can kind of see we've channeled between that 5 to 10% for, a while now. So for the valuation, I have the kind of the multiples between 5 to 10% for that reason as well. So let's go over to the income statement and see what we can find. Revenue growth, bottom line growth, and over the last 10 years. Share count obviously has been demolished over the last 10 years. Pretty much flat on, well, not flat, a little bit increasing operating expenses and SG&A. EPS per share basis, we've seen nice growth, sitting about $29 per share in the last quarter for EPS, pretty decent. Balance sheet, let's go over there. We can see that long-term debt, and then it looks like this was maybe just recategorized from long-term debt into both long-term debt and capital lease obligations. It looks like that might have been just a recharacterization in 2020. Let's see, goodwill, pretty much flat. So good operating cash flow increasing over time. All of that common stock repurchased a ton. So that's their favorite way to return capital to shareholders, which can be good if the valuation is decent. Something that I would want to know with AutoZone is really how they go about their buybacks. If it's just blind buybacks and they're not really caring about the valuation and they're just buying back whenever they can, that would be a little concerning to me. But if they do have some type of structured buyback where they wait for certain, valuation multiples before they purchase those shares, that is what I would like to see personally. So we can see free cash flow increasing. Stock-based compensation is relatively small in comparison to free cash flow, so nothing really to worry about there. So let's jump over to the ratios and metrics. What I want to see specifically is what have their margins been doing over time. Let's see, so 10 years, and their margins have remained really, really, really consistent. Bottom line margins seem to be, or net margins seem to be between about 10 to 15% or so. Looks like we've seen a little bit of margin expansion on the bottom line, but pretty dang consistent across gross profit margin and net and operating profit margin over the last 10 years. Per share metrics, you can see growing steadily over time, not only from the increase in revenue and net income, but from the buying back of all those shares and the decrease of the share count. Capital return, we got return on capital employed is about 10 to 12%. Return on assets, return on equity. All right, so per share metrics again, solid growth, really solid growth. So that's pretty cool to see. What is this? Net income per share about 120 for the year, it looks like, in 2022. Buybacks, common stock repurchase, of course, tons and tons. So enterprise value versus market cap, it's pretty interesting because they don't seem to be very leveraged, which is nice. So they're probably throwing a lot of their capital into reinvestment, into opening new stores, and keeping their debt levels pretty low, which is nice to see. Let's go to the evaluation template. We're going to do the standard market cap template, and you know what, we are not going to normalize, which we probably could make an argument from normalizing because they saw a pretty drastic increase from 2020 to 2022. But you know what, we'll give the benefit of the doubt. So target CAGR is 15%. That's a 12.5% base CAGR with a 2.5% margin of safety. For dilution, we have buybacks in the range of 3.88% on the low end and 7.44% on the high end. Now, that could potentially, it could potentially be less or more depending on, if they trade at super high multiples and they're only able to buy back 3% of their shares per year, then it could decrease. Now, if they came crashing down and their cash flows remain consistent, we might see higher amounts of buybacks. For this spread, that's what we got. Bottom line growth, we're looking at 14 to 8.4%. It's kind of what I estimated. Now, if we look at EBIT growth over the last 5 years, 13, net growth over the last 5 years, 12.6, and free cash flow growth over the last 5 years, 10.26. So I feel like this gives us pretty decent range of, maybe in the best case scenario, they're able to grow at a little faster pace, but I doubt that. I think we're most likely going to see growth start to normalize at, and maybe contract a little bit. So base case 10.95%, very bearish case 8.848. Could probably actually even go lower on that, but we're going to leave that there for now. On the multiple side, we've got EBIT yield spread between 507 for the very bearish and very bullish being 2.9, net yield spread 3.98 on the very bearish to 2.28 on the very bullish. Free cash flow yield spread of 5.86 to 3.35. All right, so average yield spread across the three different metrics. Average yield spread for the very bearish scenario would be 9.43% multiple or yield multiple at the end of the 5-year period. For very bullish, should be 5.14, and that's kind of what I was talking about previously, where I wanted to keep my end multiple scenarios basically between this 5 to 10% range. So we're sitting at probably like the more generous area right now. So we've got a pretty decently high multiple right now. So if we contracted back up and the market sold us off and we got into like a 7.5% yield or so, that would look way more enticing for an entry. So if we're looking at just getting a 15% KR, we're still a bit a ways from the base case. Base case buy point would be about 1876, with a bearish buy point being at 1455. So 1876. Oh man, yeah, we need a decent drop. We need a decent drop. Probably go back to 2022 levels, and then what the bearish case about a little under 1500. Yeah, we need to drop quite a bit, but you never know. Markets love to be irrational, so maybe they come out with a bad quarter or two. For the industry overall, though, it is going to kind of be interesting to see the business dynamics as more and more vehicles go over to EVs. You know, we've had low auto manufacturing over the last couple of years due to supply chain issues, which has probably increased the need for auto parts for used vehicles. So they could be shifting from short-term tailwinds to short to long-term headwinds, depending on the adoption of EVs and kind of the maintenance requirements across those EVs. You know, in general, you're going to have less parts to break, less things to maintain, and you know, no oil changes. Like, there's just going to be a lot less products to sell and money to squeeze out of consumers once we're more fully adopted into EVs, but that could be another 15, 20 years. We don't really know. Fair value right now, it looks like, you know, we kind of have a fair value spread between like 1256 to 19 to just under 2000, which it's pulling back a little bit. So we're starting to get maybe in that upper end range, but I still would like to see this below 1800, 1900, 1800. And I think that 1400 area is where I would get really interested. On the 5-year targets, let's see, we would have a 5-year target of the very bearish scenario would be 2301, which is actually lower than where we are right now. Bearish scenario would be 2928. 5-year target for the base case would be 3,773. 5-year target for the bullish case would be 4,938, and the 5-year target for the very bullish case would be 6,574. So it's pulling back. It's getting interesting. Starting to keep an eye on it, but I would love for it to be pulling back just a bit more. If we can get a 6-9 month downtrend going, I think AutoZone could be looking really, really interesting. And yeah, so go ahead, like and subscribe if you want to. Next week is either going to be Napa, Genuine Parts Company, or O'Reilly's. So if you're interested in those, yeah, go ahead and subscribe, and we'll catch you later.